Finally, the bulls have managed to take the mark. And now let's see what the leaders are looking like. Infosys right on top, almost 3% up on that stock. It has its peers in quick succession: HCLTech, TCS, Wipro. So IT is off to a very solid start this morning. Titan, the stock that Mangalam was just highlighting on the back of that brokerage note, 1.5% up on Titan as well, so looking good. Shriram Finance, there's intense speculation around Shriram Finance. Is a large Japanese conglomerate looking at taking a strategic sale. Company hasn't independently confirmed it, but the buzz refuses to die down. 1.5% up on that stock as well. Let's see what else. Tata Steel, Bajaj Finance, Hindalco. These are some of the other gainers. HUL and Reliance, the big boys, they're chipping in quite nicely as well. 0.5% to about 0.7% on the upside. The downside is not too much, actually. Just Interglobe Aviation, there's Max Healthcare. A little bit of red on these stocks, but otherwise looking good. And for now, guys, we're holding on to this 160, 170 point sort of a gain.
Well, that's right. The broader market, so plenty of stocks are moving around. And mentioned today, the stocks of the day could potentially be those that got hit when we didn't get a favorable deal coming out of the United States. So for the time being, you have Gokul Das, Welspun Living, and Indocount, all of them on fire, gaining anything between 5 to around 10%. On optimism that India and the United States are getting to a trade deal. So just take a look at those stocks. They're building on gains as we speak. So hopes are very high, and that's why all these three names doing pretty well. Welspun Living as well, Intercount. Let's get both those two up. Also throw in there the seafood plays. You have Apex Frozen as well as Avanti Foods. Both those two stocks, large volumes, big gainers today. Both of them up and about in trade today. EPAC Prefab, that's the other stock that's dancing away. Came out with its set of numbers. And that one as well has popped up in trade. So good up move is what we're seeing on that one. What's losing out? NMDC. NMDC is down. The price cut that came about was larger than expected. The street was bracing for a 250, 300 rupee price cut at most. The price cut is to the tune of around 500 to 550 rupees, which explains why that stock is down closer around 3%. So a good start to trade. Above the 26,000 odd mark, breadth of the market in favor of the number of stocks advancing. Yes, it's the Bali.
Manappuram and Muthoot, though, are having a bit of a dull day. Stocks have opened with a cut of about 2.5%, tracking the decline, the profit booking, and the unwind seen in gold prices. Dixon Tech, I think there is a CLSA downgrade on Dixon Tech, and that stock is lower by close to about 1.2%. But, really, it's the, garment names, and the gains are extending to so many other stocks. So it's Vardhaman Textile, Himmat Singha Seed, Trident, across the board. We spoke about Kitex Garments and Gokuldas Exports, which are seeing a double-digit up move. But the gains are cutting across the entire textile value chain, and stocks are doing very, very well. And the other one are the shrimp makers, so Avanti and Avanti Feeds, for instance, up also close to about 5.5%. Jain Resource Recycling, again, a recent listing, and the company has announced some expansion plans, and that stock has opened up with a gain of about 2.5%. A couple of banks are doing well. AU Small Finance Bank, a stock Nitin was just talking about that he likes. DCB Bank, also higher in trade. Shriram Finance has now moved up to a gain of nearly 1%. And in IT, mid-cap IT, you've got a Birla Soft, Sonata Software, Persistent, Emphasis, Coforge, also opening up in the green. So generally, green on the screen for IT this morning.
Okay, all right. Well, time to go to our market expert. We have Mihir Vora, Chief Investment Officer at Trust Mutual Fund, who joins us on the show. And this time, it's special. It's in the studio. Hi, Mihir. Good morning. Welcome to the studio. Extending greetings to you, your team, your family as well. All the best for the new year. And hopefully, we'll have better times for the markets as well. That said, Mihir, in the last couple of weeks, you've got into a good space, right? The feel-good feeling. I mean, towards the end of September, everyone was singing, "Wake me up till September ends." And October has been very, very good. We're up more than 1,000 points on the Nifty itself, and individual stocks have done quite well. How are you feeling about the market post this big run? Earnings don't seem to be that bad. Q2 was supposed to be a washout. It seems to be a little bit better. So how are you feeling about the Indian markets? And do you think for the next year or so, we should be bracing for better times?
Absolutely. First of all, wishing everyone a great Vikram Samvat 2082. I think the situation as we start the new Samvat seems to be a little bit of a mirror image of what we had, as the situation last year. So last year there was huge, optimism, and the markets had done so well. So everybody's in the rara mood, and India actually had outperformed most of the other markets. This year, we have not performed.
Mihir, sorry, I'm so sorry, more to interrupt. I think we'll just fix that audio issue with your mic. We'll come right back. Let's get Mihir's mic fixed up. In the meantime, I'm just checking, is there any other movers and shakers? But actually, textile and apparel is the only real clear trade. And like Rima and Nigel were pointing out, there are so many other names. Look at even Pearl Global now, 5.5%. Indo Count, Gokuldas, even Arvind. I mean, Arvind is more local facing, but anything and everything that's textile or apparel is up and about this morning. But I think, Mir, yeah, we've got the audio back up. So you were telling us how this year, the start of this year, this Samvat, is a mirror image of last year.
Absolutely.
Because you were in peak optimism, September, October last year. Now it's some optimism coming back after a 12-month wait.
Absolutely. And, everybody's complaining markets have not done and all that, for the last 12 months and all. So it's a good place to start with psychologically, because definitely there's no euphoria at this point in time. On the other hand, even the macro situation is a bit of a mirror image. Last year we had more of inflation concerns in India. Now it's the other way around. There are potential inflation concerns brewing in the West, but India is in a good spot. We have no inflation. In fact, there is ample scope for cutting rates, etc. Last year we were not sure about government support, but this year, government, RBI, everybody's whatever it takes mode to stimulate the economy, budget-wise, GST cut-wise. And we have seen proof of the pudding that these cuts worked, and at least the initial ground level feedback from the Diwali season seems to be very good. So we are starting off on a good valuation base with low expectations, somber kind of expectation, but the incremental delta on the macro seems to be better.
Mihir, so the catalyst for an up move is always earnings growth, right? So what do your channel checks suggest? Where is growth coming in? What are the numbers going to look like for Q3 and Q4 that you would be comfortable chasing? So we know Zomato does well, but we also know it's an expensive stock. So tell us about the growth stories that you are willing to chase at this juncture right now.
See, there are two things to look forward to. One is the immediate quarter, which is the December quarter. And as you've been reporting, everybody's been reporting that, consumer has gone ballistic and plus 20%, plus 25% on a YOY basis. Looks like the consumption spend for the busy season. So December quarter will definitely be good. Stocks have run up. All the auto stocks, the durable stocks, the discretionary stocks have done very well. So the question is whether this momentum of consumption will sustain into the next year. If the trade deal happens and the feel good continues, then we could see that momentum continue not only in consumption stocks, but even in the financials and the investments linked segment. So that's what we are looking forward to.
Are you betting on it?
This quarter consumption should do well because we have the anecdotal numbers. But beyond that, what happens is what the market will also
Are you betting on it that the consumption lasts?
Absolutely. So we have increased exposure to consumption. But the question is, how much more do we need to now go into banking and the other segments also?
Okay. And that is only contingent on a trade deal being struck?
Trade deal being struck and the momentum in consumption continuing.
So the top three themes that we're looking at, to play from here on is what, according to you?
So consumption continues.
Yes.
Question is, how much more do we want to go into banking? Because banking is one of the most ignored sectors for the last couple of years for good reasons. But now, if the momentum continues, then there is no way that the economy can grow at 7-8% or even 6.5% without the banking segment growing at least 12 to 14%.
Yes.
If that credit growth comes through at about 14% or so, 13 to 14%, then we could have a good re-rating of both the private sector and the public sector banks. So far, most of the heavy lifting as far as performance of the financials is concerned has been done by the capital market stocks and the NBFCs.
Right.
But banking has much more weightage in the overall indices. So if banking performs, that will be the engine to drive the markets for the next leg.
So consumption and banking.
And of course, I keep saying, structurally we can't grow at 7+% without physical investments.
Yes.
So the push on infra and more importantly, I tweeted about it also, private sector capex, the animal spirits of the private sector capex have to come back.
Yeah, which we've not really heard from any bank. Every time in these banking result commentaries, I'm always waiting to see if any banker is saying that suddenly, corporates are lining up. But I think it's, the hopes are that it'll start in due course. On consumption, Mihir, because it's a very wide basket, you're clearly positive. But then what side of it? Staples or, consumption? Anything is consumption, including autos.
Absolutely.
So if you could just be a little more specific there.
So we focus more on the non-staples part of it because staples, most categories except some innovative companies, most categories have become saturated. So if you look at toothpaste, toothbrush, soaps, etc., they're not going to be high growth categories and valuations are not cheap in any case. So that is a structural underweight for us. We're looking at more of incremental data points on the two-wheeler side and the passenger vehicle side.
Okay.
Because we have, if you if you look at the last few months, numbers are fine, but look at the structural issue. Car growth and two-wheeler growth has not been more than 5% over the last 5 to 7 years. So if we are really talking about prosperity and rising income levels, then that has to pick up, to at least 10% or 7 to 10%. That's when we can see that, okay, there's a trickle-down impact of job creation, etc.
On two-wheelers, what do you like? What's the focus out there?
On two-wheelers, we like most of the, innovative producers. So there are some which are more rural-focused. I think earlier, it used to be more urban-focused.
Okay.
Now, the rural economy also seems to be picking up, and especially after this monsoon. So, we're looking at a basket of two-wheelers. Earlier, we were more towards the urban side, but now we are graduating to the more rural plays also.
And the EV plays?
In EV, we actually have the two-wheeler EV.
Okay.
That's where we are focusing more on. We rather go for a pure play.
Okay.
And there we believe that the stock that we own is more of a winner in the relative scheme of things.
So EV as well, got that. By the way, we'll have a full discussion on autos coming up in just a bit. That is our special segment, Quarter Se Quarter Tak, and Sudarshan's going to tell us what the expectations are. Because anyway, since the GST cuts, most OEMs have been reporting bumper bookings and bumper deliveries as well. Now, Mihir, you said that, that we are not at a point of euphoria in the market, and I completely take that when it comes to the secondary market. But the primary market? What has been going on over here? And what do you think about the spate of new IPOs, the way the paper has been digested? And tell us, if you participated in any of the recent issues, and what's the message to investors? Because the IPO frenzy refuses to die down.
No, absolutely. My message is don't just look at the grey market premiums.
Yes.
People are just oversubscribing, putting in leveraged applications by looking at the grey market. But we have seen more than half of the IPOs are trading at a par or discount to to their listing prices or the IPO prices also. The study over the last 12 months. So invest in IPOs the way you would invest in a secondary market. Look at the same principles apply, fundamentals, valuations.
So what have you liked here, if anything? I'm not saying where you were anchor investor, but maybe bought a little later. Any of the new companies, new businesses that caught your fancy?
Yeah, so we bought some of the auto stocks which got listed.
Okay.
Yeah, the large one.
Hyundai.
Yeah, no names. So wherever there is value or relative momentum building up, you don't really need to buy only in the IPO. You can follow it up after
anything
after
else
listing also.
apart from autos?
We've been very selective, frankly speaking, and most of the anchor books that we invested in are in the smaller ones. So nothing that makes a big difference to the portfolio to begin with. But the fun is basically to chase it after it gets listed, because that's when the actual price gets settled.
So Mihir, you would have attended the morning meet, right, at Trust. Did you all discuss about what's happening in the oil and gas space with US imposing sanctions on two large Russian oil and gas companies? What are the implications now for the Indian oil and gas? Take us through your own views on this.
So we have some exposure to the integrated OMC companies.
Okay.
And we believe that, of course, there is a benefit of Russian oil per se, but oil prices have gone down, structurally. So even if the supply of Russian oil reduces over a period of time, and my belief is that even if the trade deal happens, it won't be a 0-1 kind of a thing. There will be a phased kind of agreement, formal or informal. So to that extent, I think it's the valuations in this space are quite attractive. Oil prices have structurally come down from almost $70, $80 to close to $60. So to that extent, I think marketing margins and refining margins will be maintained. So for the integrated players, it's less of a shock.
And just purely today's news about the sanctions, it complicates the financing, for instance, the logistics portion of it. Crude prices have gone up. So
incrementally, as I said, if you look at the profits of the OMCs, they are determined by two factors. One is the refining margin, second is the marketing margin. And the government has been, keeping the final pricing to the retail investor in a way that there is enough money to be made by the OMCs. So to that extent, I think there is still a buffer. Yeah, what we are seeing actually is quite high profits, maybe not sustainable, but I don't think the market is discounting such high profits for a long period of time. So even if profits come down on a quarter-on-quarter basis, it should be fine.
And crude has declined, as you said, right? The larger picture is there's been a 15% fall in crude prices.
So what we need to worry about is not the refining margins alone, it's the difference between oil prices and the retail prices.
Yeah.
One more question.
By the way, just since you guys are discussing oil and gas, I think we'll play out the statement that's coming in from Reliance Industries in just a bit. This is the official statement coming in from the RIL spokesperson, saying that the company is recalibrating Russian oil imports to align with the Indian government's guidelines. We'll just put out the whole statement in just a bit. That's really, really important. Official statement from Reliance Industries that the company is recalibrating Russian oil imports to align with the Indian government's guidelines. So if anything, I mean, I don't want to jump the gun over here. It's very, very sensitive issues. But we don't have an official confirmation from the Indian side just yet of India looking to reduce how much, substantially, wind down, Russian purchases by the end of the year. Remember, the US president has said that by December, end of this year, it'll come to almost nothing. That's his exact statement at the White House overnight. And now we have a Reliance Industries statement saying that there is going to be some sort of a recalibration of Russian oil purchases. So extremely important. But Meher, I guess, beyond oil and gas, if indeed this is that bargaining chip which we decide to give in and ultimately get that trade deal done, in some sense, is that the last piece of the puzzle that the market has really been waiting for to come in place? Let's say if we get a deal announcement over the next 2-3 days. Are you expecting a big gush of money in the market to flow through? How should we prepare for the deal to be finally announced? It's been in the making for 6 months now. Certainly.
So I think the retail investor has not given up in any case.
Yeah.
So I don't think retail needs to do much more. The delta will be in the foreign flows.
Yeah.
We have seen significant outflows. In the last couple of weeks, thankfully, the outflows have reduced and we are seeing some trickle of inflows.
Yes.
Probably it's on the expectation of some kind of a deal happening. So the last piece of the puzzle was the FII. And if they come in, I think we're in for good times.
Well, that's right. They've been underweight the Indian markets and heavily net short as well. Exactly. So we would like them to come and participate because the retail flows have been rock solid. A final question from my end before I let you go, Meher. State elections, that's going to be a trigger for the markets, which we will be tracking because after a while, we're going to be bracing ourselves for another state election. So BR goes first in. Impact on the markets?
I have frankly given up on monitoring state election because
that's not a big trigger.
Big trigger, and there's an election virtually every year.
Yeah.
Some important state election every year. So it's a short-term thing, and given the way the government has shown resolve in various other policy issues, I think those are the ones that matter most.
Okay.
Has gold peaked out? Gold and silver?
I don't think so, because the structural driver, which is ample global liquidity, and the US and the Western world needing to inflate its way out of their debt issues, that structural story continues.
So if you're allocating fresh money, what would the proportion be? The last 1 year or so, gold has outperformed equity markets and by a margin. But now, post the recent underperformance and going by the elevated levels of gold, just purely because it's up 50%, if you're allocating fresh money, what would be, if you had to put it bucket-wise, into fixed assets, into equities as well as gold, what would it be, the proportion?
I'd say precious metals should be about 10 to 20% of the portfolio as a good buffer in the long term.
Okay, and the remaining would be equity and fixed.
Equity, fixed income. I would say, given the situation, about 25% exposure to fixed income is also a good idea.
And equity gets the largest bite into it. I think the sector of the morning actually is tech because that's doing the heavy lifting out there. And the Infosys promoters have gone ahead and said we are not going to participate in the buyback. Now, various ways of looking at it. The street is looking at it very, very positively. But the reason they're not participating in the buyback probably be because of the taxation, right? So that could be a reason. How are you all approaching tech, though? Ratios are looking okay, far more palatable than what it was a year or so ago. And maybe, in fact, some believe that the worst has already played out. Spends will pick up from here on. Things should look up in FY27 onwards. Are you in that camp?
Yes and no, in the sense, of course, tech will continue to be a secular growth story. But I think the large cap companies will not be high growth secular companies, secular high growth companies. Because I think the existing business model can only give them 5 to 10% growth. And for a country like India, that's not the kind of growth we aim for in our portfolio. We're looking at much higher growth rates. So within the IT services pack, we have the mid caps, some of the specific mid caps, which good management promoters, which have more fire in the belly, so to say, to grow faster. But the other theme in tech, which is the AI and the data center theme, that's what we are playing for. So we have a couple of names in the data center space.
I think NetWeb, right?
We have got a couple of names, which are either setting up data centers or helping to set up.
So you wouldn't mind the mid-size IT companies that will grow at a higher rate and also have a better business model rather than go for the large cap names where growth will not be that much, though they're solid companies. So the preference will be for mid-cap IT.
Mid-cap IT, absolutely.
Okay, go for growth. That's the message. This new Samvat, Vikram Samvat 2082. Yeah, 082. Yeah. All right.
And markets are also going for growth now. Now it's a 200-point up on the Nifty. We had a gap up opening, but we opened up, what, 120, 130?
Yeah, we're building on the gains.
We're building on the gains now. So it's... let's see. We're about 200 points away now. Exactly.
Market's doing well. I'll tell you what, Tony. Team India is not doing so well. You know, we're only 17 runs and 2 wickets are down. We've started a little bit slow and going at a run rate of just 2 to 3 runs and over. So hopefully our boys pick up. I think Gill just went, and you know, we have Rohit who's still out there. So
tracking both the on-screen action
and unfortunately Kohli as well has gone for a duck. So hopefully our boys, you know, get some inspiration of what's going on in the markets. And by the end of today, we'll be celebrating both 200 points higher on the Nifty, and hopefully the boys as well in blue, they fight back.
Oh, super. Well, Meher, thank you so much for joining in. Once again, wish you all the very best for the new year that has started. Thank you for joining in. Okay, back to the screen. So let's actually look at some stocks as well that are bouncing around. Bharat Forge is up 4%. They have won a pretty large order actually on the defense side. For, I think, carbines along with the Adani Group. So that's one stock that's on the radar. There's also EPAC prefab. Let's go to Vivek to find out why EPAC prefab is buzzing as much as it is. It's almost 12% higher. Okay, it's from that 12% gain now, it's still 8.5% higher. Vivek, fill us in on the details.
Well, that's right. Remember, this is a recent listing in a market cap of around 2,000 crore. A company like the name suggests, makes prefabricated steel buildings, and very similar to a Pennar Industries. Now, the company, over the weekend came out, over the last 2 holidays, has actually come out with Q1, Q2, as well as H1 operational updates. Company got listed towards the end of last month. With that context, revenues for Q2 higher by over 61%. The EBITDA very strong, higher by over 80%. EBITDA margins expanding by over 130 basis points on the back of operating leverage benefits kicking in, and profitability more than doubling in. Order book on a sequential basis appears to have moderated slightly, but still quite healthy at over 650 crore. So overall strong set of numbers. No wonder then you're seeing the stock doing very well in the session today.
Okay. Thank you very much, Vivek, for joining in. Now moving on to the next topic of discussion, and now we're talking about retail, the pickup in consumption seen during Diwali. So joining in are Nilesh Gupta, Director at Vijay Sales, and Pushpa Bector, Senior Executive Director at DLF Retail. And we will be discussing with both of them the festive season sales, the incremental sales, especially on account of the GST cut, and the demand trends across categories and how they see growth panning out for them. Thank you very much, Pushpa and Nilesh, for joining in. Mr. Gupta, let me get in the numbers with you. What have been the festive season sales for you at Vijay Sales this time around? How does it compare with the prior year? And if you could break it up category by category.
So good morning, everybody. I think this has been one of the most good-looking, or I would say the best festive season in the last 1 decade. Primarily because of the GST cut, and also because the festive mood was around, the consumer sentiment was on all-time high. And in the initial first 10 days of Navratri, from 22nd onwards, we saw very high turnout. For the simple reason is 15 days prior, people had stopped buying electronics for the simple reason because the rate was coming down. But nevertheless, even if you account for the pent-up demand which took place from 22 to 30th till the Dussehra, if we cut that off also, we have seen a high growth of 20% over last year. Now, this is a growth on a good base. Normally, we don't see more than 8 to 10% growth. So we have seen double the growth which we have seen. Leading the pack in the category-wise, if you ask me, it is basically the televisions, because television above 32 got the maximum benefit of 10%, just like air conditioners and dishwashers. But people were all out wanting to buy large screens. And I think more than the GST cut, along with the GST cut, they got an excuse to buy that 65 inches, 75 inches, and even people have bought 100 inches, which used to be a rarity earlier. So I think overall the television has benefited the most. Air conditioners was good, but it could have been better. But because the weather was not so conducive, that's why we'll see a lot of action in the air conditioning category during the summer 26. Dishwashers has become now at least one of the staple product, at least in the metros, where I think when a person is doing up the house, how he buys a washing machine, I think dishwasher will always be one tick, 100%. On the other side, these were the effects of the GST, but because the sentiment were high, we have seen a high growth in mobile. We have seen a very high growth in laptops. We have seen a growth in washing machines. And kitchen appliances always do well during the season. But coupled with this, I think another phenomenon which we have seen is the gifting segment this Diwali was much better than the previous Diwali. So I think people not only bought for themselves, but even for gifting, they bought a lot of electronics, Bluetooth speakers, mobiles, small appliances, and the likes. The idea is when the festive spirit is on, the consumer sentiment was positive. So I think people not only bought for themselves, but also bought for their family and friends. Overall, a really good Diwali. And the best part is, I don't think so this is going to stop here. The positive sentiment and the GST cut will have a long-lasting effect. I think the rest of the financial year also we'll see a lot of action in our categories, and we'll see much better growth over last year in the coming months too.
All right. Good to hear that, Mr. Gupta. Personally, I was at your outlet in Bandra West, and it was full, and service as always was good. I went and bought a token, micro oven. So good stuff coming in from your staff as well out there. But let's welcome Ms. Bector, the Senior Executive Director at DLF Retail, on the show. Hi, Ms. Bector. Good morning and festive greetings to you, your family, and the entire team. Tell us, what did you observe in the last few days? What were footfalls, say, towards the end in the last couple of weeks or so that compares with normal averages and in comparison to your expectations? And also, if you could tell us which category saw the highest amount of interest. Please go ahead, ma'am.
Good morning. Well, it has been a very, very good October for us overall. Like Nilesh was saying, I echo that sentiment that 2-3 things have happened, right? One is because of the income tax cut, a lot of money came into the hands of people, disposable income, GST rate cut being another one. And of course, we also see the Central Pay Commission having been implemented. These 3 elements ensured that in the NCR, consumption did rise, and we could see this from September 22nd on. We in DLF had anticipated it, and we created a shopping festival, the DLF Mall Shopping Festival, starting from 4th October. And I must say that the trends have been really good. Coming to categories and footfalls, overall footfall has been up by around 12% year on year, which is if I look at it from a Q3 to Q3 point of view, we look at a much more robust Q3 as compared to the last financial year. The other element of sales has been on an average in double digits, but few categories have outperformed, of course. One is jewelry. Jewelry did really well, as did, electronics, and this time around, even apparel has bounced back rather well. Last year, we did have an issue with apparel not doing as well as what was anticipated. And as you know, 35% of our, malls do house apparel, and it's an important element for us. Overall, I would say people had a lot more shopping bags with them, A. And B, also, one could see that they were really enjoying the entire buzz around the properties. All our properties were well prepared for the same. The second element is, of course, gifting. Now here in the malls, what we also see is that wedding is a very, very important component for consumption to increase. And this year, wedding is going to be long, and the season's going to carry on till March and beyond. We saw wedding consumption to go up drastically. When I talk about luxury space, we saw Indian designers, their sales on an average have gone up year on year by 30%, which is very encouraging for us.
Sure.
It shows that wedding consumption is also back.
Sure, Ms. Bector, sounds good. I mean, more footfalls, more consumption, and more people visiting the malls, which brings me to the question of what all this means for you. Obviously, I mean, it's not a straight line flow through in that sense. But in general, if the sentiment remains buoyant, will it translate into better rentals? And, what is the rental cycle? I mean, if there's some way of mapping this, say how much or how many million square feet perhaps comes up for rent negotiations over the next 12 months? If you could give us some, sense of what this buoyancy will mean for mall rentals.
Absolutely. That's a good question. So what we do is that on an average in our existing portfolio, we have around 500,000 square feet, which comes into new leases with the deed ends happening and new leases coming up. There, we definitely think that the rental will go northwards. We have also 3 projects that we are opening. One is the Summit Plaza in Phase 5 in DLF Gurgaon. The second is in Midtown, which is in West Delhi. And the rentals over there, we had made sure is already in sync with the fact that it is going to be at least 20% higher than what we had earlier anticipated. We think that the usual 15% escalation won't hold now. We would at least look at a 20 to 25% escalation over the previous rentals, because the sales are good, the sentiment is good, and we will make sure that the right jewelry, D2C brands, apparel brands, etc., find good projects and good properties, but at rentals that we think is much more fair to the market.
Yeah. 20 to 25%, increase in rentals. Wow, that will definitely drive rental revenues quite a bit, retail revenues quite a bit for DLF, I'm sure, this year. Nilesh, season's greetings to you as well. By the way, ma'am, season's greetings to you as well, of course. Nilesh, the question is, you described this amazing buoyancy around Diwali time, and it's very heartening to hear that. The question is, how long will it sustain? Are you now preparing for maybe a post-Diwali lull, or do you think this buoyancy can actually extend because the GST cuts are permanent, and then you move from Diwali to then the Christmas gifting season and New Year and then Valentine's and so on and so forth? So would you expect the buoyancy to continue? And again, some numbers would help. Overall for the year, therefore, would it be realistic to expect, say, 15 to 20% growth?
So first and foremost, I feel I made a mistake of telling the truth of the growth, because if the rentals are going to increase, it's going to trouble all of
That's true.
So I think, there's always a lull after Diwali, but what happens is we always compare period to period. So what we see is this buoyancy, as you rightly said, the GST cut is not a one-time Diwali gift by the government. It is basically there to stay. So I think what will happen is the growth is going to be there. So whatever lull we had post-Diwali last year, that compared to the same lull will come, but then we'll see a growth of, which I expect at least 10 to 15%, if not 20%. And then there is another thing which is very important is categories. The GST cut will lead to the growth in the category. For example, it will lead to a very high growth of televisions, especially the premium, the large screens. So people today, the consumption of TV has increased for the simple reason is because of the OTT platform. Movies, there's a lot of movies which are being aired directly, premiered on OTT platform. A lot of serials come in, and so people want big screens. At the same time,
this should last.
Yes, so it will last. Second is your dishwasher. Now that's a category which was never in the consideration set of the consumer, except during the COVID period where people wanted to buy because of the issues which we all know. But now I think with the GST cut, this also will lead to one other category which will grow. So what is happening is, and the moment, and this all buying changes the mindset of the people. So it doesn't stay back, okay, he's bought a large screen television, so that's it. Large screen television will lead to him buying a home theater to enjoy the movie experience.
Got it, Nilesh. So I'm so sorry rushing you there, but that buoyancy is lasting in the consumer's mind. It's also lasting in the market. And if the market continues to be very buoyant, it has its own wealth effect as well, right? It all ties in together. I'm afraid we're out of time on this conversation. Thank you so much for joining in. Very, very valuable inputs. Helps us understand the mind of the consumer better. Well, with that, we have to just take a quick break. 200 points up on the market, and we are back with the market conversation full throttle. Sandeep Tandon of Quant Mutual Fund joins in. All-time highs around the corner. What does this mean for a retail investor and their investments? We discuss this in just a bit. Welcome back. It's a double century on the Nifty, and it's pretty steady so far. We are just about 200 points away from that all-time high. Sandeep Tandon, founder and chief investment officer at Quant Mutual Fund, is with us. Sandeep, season's greetings to you. Wish you a very happy Diwali and a very happy New Year. You know, this year has taught the lesson of patience to retail investors, and they've actually, held back quite nicely, I guess. Now, what is your sense? I mean, are you expecting all-time highs to come and then the market to continue building up from here? Or as, some people say that usually after an all-time high, because we've had a pretty breathtaking October rally, do you expect some consolidation to go back? Basically, what are we in for as we get into the last quarter of the year?
See, you have to look at the background where this rally is coming from. Obviously, people were extremely bearish. First point, nervous about the trade. Okay, rupee depreciating significantly, and along with that, the metals and the commodities was rallying sharp. Okay, that was the background. And obviously, it's a very perfect background when we look at these inflection points. That's the reason, to be precise, we are largely 100% invested in, except the small cap, we are largely invested in the market. We have to understand when you get these data points and people conviction is missing and your data points are convincing bullish, then it's a time you have to get all into and participate this rally. So I think this rally has more legs. Maybe it has rallied significantly. Let's say, example, bank has rallied significant. Small profit booking can happen here and there. But largely, we are constructive on the market. Three reasons for that. First of all, rupee also has peaked out from a longer term perspective. And that is what I'm trying. Maybe from a short term phenomena, it has corrected and can recover a bit. But I think we are seeing a signs of some sort of USD INR peaking out, means rupee has a potential to appreciate. Or let me put this way, the pace of depreciation, that cycle is peaking out. The FIs, which has been significantly underweight, has reached also another important limit. And then we have seen the extreme high short positions completely missing. They were shorting has also spiked, the selling pressure which we have seen, and plus the underperformance which India has seen against both emerging market as well developed market. So I think the background is more constructive for Indian equities as compared to global equity. That's the first point. Second thing, the government initiative, whether you talk about interest rate easing sort of thing or GST benefit or the income tax benefit which we got in budget, I think a remarkable game changer events which has played out. And I think we have to understand that the lag effect, these things plays out. If you're expecting that immediately will not happen, but as the previous panel was talking about, after 3 years, at least I can also say we are seeing a better sentiments around Diwali season. Markets are, people are seeing activities getting built. So I think it's a very constructive background for India equity. One can't be negative from the current levels.
Okay. All right. Hi, Sandeep. Good morning. Welcome to the show and wishing you, your team, all the very best. Well, the big deal that was announced just a few days ago was on RBL Bank. And y'all have kept the faith. If I look at it over the last 2 to 3 years, you'll have consistently been building a position out there. And if I got the number correct, the last reported position is around 6.5% of the bank y'all hold. Could you tell us what are your take on the deal? Your shareholder nod will be crucial as well. How happy are you with this sort of a deal that takes place and your initial assessment?
Nigel, yes, you rightly said, we are one of the largest shareholder of the company, and we have been holding for a couple of quarters or other few years.
Yeah.
And yes, when we spotted that opportunity, then stock was available at 5,000-6,000 crores of market cap. Banks, the broking company was significantly quoting at premium, wealth management company where bank license was available, and Verse was behind that. So obviously it's a constructive background. And if I have to look at even whatever RBI has, if assuming that node has come and they're talking about 60% thing, approval coming to a foreign names, obviously is a game changer transaction, not only for RBL, but also I look at more from a banking industry in general. But the only point we have highlighted to the management is that being one of the largest shareholder, we think prices has not been fair, because to sell a company controlling stake at the SEBI determined prices is not fair. Long deal is very constructive. There's no debate on that front. But from a shareholder perspective, we think the prices should be significantly higher than what was quoted, because if you're selling a controlling stake to an investor, then an investor has to pay a premium significant premium to the prevailing prices. That's the one important observation which we have.
That's an interesting point, Sandeep. You think the price should have been significantly higher, but it is what it is. So, I mean, I know this is a bit of a premature question right now, but as a major investor, would you sort of keep the faith in the new Japanese management as it comes in? Because for the Japanese, it's going to be a new lay of the land. And actually, they're coming in several entities, right? There's a Japanese entrant in Yes Bank as well. And then there is Emirates NBD coming into RBL Bank. There's some talk of what happens with Shriram Finance as well. That could be another, Japanese entity, but it's still being speculated. So there's a lot happening with these foreign players now entering the Indian lending landscape. What do you make of it as a very active participant, as an investor? And are you thinking of staying the course in some of these transactions? Or do you feel that it's just safer to remain with the fully Indian-run, Indian-owned, operated, tried and tested names?
Frankly speaking, as I said, it's a game-changer transaction. I said the whole landscape of the financial services, particularly the smaller banks, will change. And which is a good news from the longer-term perspective, that it also showcased the faith in the banking system that foreigners, whether it's talking about the UAE largest bank coming or from the Japanese bank coming to India. Obviously, it gives us a perspective that despite the noise and narrative which we have been hearing from the market right now, but I think it's a very constructive background, and I think a lot of it should be given to the RBI, the way they have managed things, and the perception has maintained quite well robust for the Indian banking system. So I think it's a net is a constructive. All the step, if I have to look at, and some more announcements expected from various other names which we are hearing, if that happens, I think it will re-rate the sector. And apart from re-rating, what is very important is the confidence building exercise. We have been struggling on the FDI front. So such transaction will not only for the banking, but it will boost overall confidence about India equities.
Okay, very quickly, Sandeep, before we let you go, the other big position you're built on is on the big boy Reliance Industries as well as Jio Financial Services. And it's good from a market perspective as well, because the giant seems to have woken up post these results that we saw over the weekend as well. Your view, what are the triggers you're factoring in for these companies from here on? There could be an IPO on the cards. What else are you factoring in?
So, Nigel, as you know, we generally don't allow to comment on individual stocks, since RBL was the very specific event which played out and larger interest we're talking about. We remain very constructive on the digital as a theme, because we think banking sector globally will go to radical changes. Whatever banks you are seeing will not exist in this form in next 2 decades. So obviously, when we're talking about CBDC coming to picture and digital banking is the future. So obviously, these are the data points that you look at large macro perspective in identifying the stock. And similarly, we remain equally constructive on the green energy as a space, or renewable energy, whatever name you want to call it, or even talk about telecom as a space. And plus for these so-called these large caps name has been not getting the right price or right valuation what they deserve, where some of the smaller names in significant size quote a significant premium. That was the very simple thesis we have. These are giants company and they have delivered historically. So I like to maintain, we as a house, right from July 2024, we are saying we are in difficult phase of market, easy phase of market is over. And we are not on the extreme risk on what we have seen between 2020 and 2024. Hence, we are more skewed towards safety. So liquidity is the first priority. Safety is the second priority, and returns are the third need, or the tertiary need. That's the way we define this period. And hence we felt some of these names which you talked about has right opportunity. And that's the reason we own very substantial holding in our portfolio. And we remain constructive on the same.
All right, Sandeep, great conversation. We would have loved to chat more, but out of time. Thank you very much for joining us today. Moving on now to the auto space, it's time for a special segment, Quarter Se Quarter Tak. We'll get you the earnings expectation. Sudarshan now joins in to tell us how Q2 will pan out for the auto sector.
So for the auto sector, it's a crucial quarter, one that's noisy, uneven, but also filled with signal for what's coming next. So let's start with the big picture. Earnings growth overall is expected to be modest, driven by an early festive season, but weighed down by input cost pressure and uneven demand recovery across these segments. Here is how volumes stack up year on year. Tractor is the strongest performer with 20% growth, thanks to improved monsoon and pre-festive rural demand. Two-wheelers and commercial vehicles are holding up well, growing in high single digits as retail momentum has improved. Passenger vehicles are slightly soft with volumes down 1% YOY as high base and discounts weigh on wholesale numbers. Now to the four-wheelers, where Q2 will be about narrative, not numbers. Let's take it one by one. For Maruti Suzuki, earnings may be unexciting because sustained high discounts, price adjustments, post-GST annual pay revisions and ad spends for the Victoris launch could compress margins slightly. For M&M, it's expected to deliver steady growth, though margin may dip sequentially due to higher promotional costs and rising EV contribution for Mahindra & Mahindra. Hyundai is seen relatively better placed because operating leverage from sustained UV sales and premium model mix could offset higher ad spends and festive schemes. Ashok Leyland, it may be a stable quarter, volume growth is visible, margin is steady, and commentary on H2 recovery in truck demand will be the key to watch out for. For Tata Motors, JLR remains a drag. The cyber incident-led production halt will hurt output this quarter, although UK-US tariff relief came in late September and JLR still faces some of the more headwinds of fading model cycles, higher incentives in the US, and intense competition in Europe and China. In the two-wheeler space, it's shaping up to be a good quarter for most listed OEMs. Volume growth is around 15% year-on-year, supported by strong domestic sales and a revival on export front. Margin is expected to expand by 40 to 80 basis points on a sequential basis. Bajaj Auto benefits from a favorable currency and export recovery, especially in Africa and Latin America. Eicher Motors should see higher operating leverage from volume recovery in Classic 350 and Shotgun 650. TVS Motor is likely to see margin expansion driven by premiumization in the Apache and EV portfolio. In the ancillary pack, we may see another subdued quarter because weak global production trends and tariff uncertainty continue to weigh on the sentiment. Bharat Forge and Samvardhana Motherson are likely to report weak core earnings, with EPS cuts are very much visible in street models. Long-term growth drivers are shifting from pure auto exposure toward defense, electronics, and mergers and acquisition opportunities for these company. So overall, in conclusion, Q2 will be noisy with mixed signals across segments. The street will focus less on reported numbers and more on growth commentary. This quarter may not capture full optimism of the GST-led price cuts and festive sales boom, but it sets the stage for a stronger H2 and FY26 outlook.
And indeed, and we have to see how much of this is already in the price. Are companies going to sound optimistic enough to keep the stock momentum intact? Because if you just look at the Nifty Auto Index, it is one of the best performing indices of the year, the calendar year, with a gain of about 20%. And it's been a very, very smart rally from late September as those GST cuts were announced. Let's pull up a one-year chart of the Nifty Auto Index. It really tells the story. From around 15th of August, end of August, that auto rally really picked up. And it's been literally up and away since then. Jay Kale, Executive Vice President Research at Elara Capital, is joining in. Jay, I'll start right there. So, Q2 is one aspect. So let's take your growth pick in terms of just showing the maximum momentum, either on growth or margin expansion. Which are the OEMs that perhaps could dazzle, keeping the stock momentum intact as well? I think you're on mute, Jay.
Yeah, sorry. Good morning and festive greetings. I think, yes, definitely this time it's about, the festive season and GST cut-led demand. I think a lot, the street would kind of ignore some of the earnings reported, and it will be more of the commentary and the festive growth outlook going forward. We've seen pretty strong commentary from Maruti and Hyundai coming in during Diwali, the Dhanteras sales. And I think that should get reflected in Vahan in the coming days. So overall, I think, from here, what we believe that a 15% odd growth for the festive season is kind of getting baked into the numbers of the OEMs, and which is getting priced in the stock prices. And from here, for the stocks to move ahead, I think what will be keenly watched is who are the market share gainers from here. In our view, in passenger vehicles, as we see the current trends, the first-time buyers coming back, we see Maruti gaining market share. While in the two-wheeler space, we see strong momentum continuing for TVS. While for Mahindra, it will be more of the upgrade customers that will come to the rescue in terms of ASPs and margins. So these three would be our preferred picks in autos, and the commentary will be keenly watched.
Jay, hi, morning. What are your channel checks suggesting in terms of the sales that we've seen from, say, 1st of October till up until now, or the festive season as we calculated? What are the numbers looking like?
Yeah, I think if you see festive to festive, the way we calculate, say from Navratra to till date, the growth seems to be closer to around 20-odd%. Of course, one has to factor in the postponement of purchases that happened post the announcement, and hence we would also like to see the festive season from Ganesh Chaturthi till date, which has been less than 10% as of now. But I think once the Diwali numbers get factored in, I think it should trend towards double digits, which is what the stock prices are essentially factoring in. So as of now, we don't see much of earnings, change as such, given the current festive trends.
And double digit would be high double digits if you calculate from Ganpati to post Diwali, or low double digits?
I think it will be low to mid double digits for Ganpati to Diwali.
Okay. And considering that post the festive season, there is a bit of a lull, what would the numbers look like, say, from November onwards till March?
I think, there is definitely, you will not see such high double-digit growth momentum sustained post the festive season. While the trends of growth rate will definitely be higher than what we saw pre-GST cuts. So what we are expecting for the passenger vehicles post-festive is close to 5 to 6% for the balance November to or December to March period. And for two-wheelers, we are expecting a 10 to 11% on a low base for our full year growth numbers to be met.
And auto ancillary, what is the expectation? Because we have seen, the previous quarters were a bit subdued. There's been margin pressure, etc. What's the broad expectation?
Yeah, I think auto ancillaries will be, case-to-case basis. We will expect passenger vehicle and two-wheeler exposed ancillaries kind of benefit from the kind of growth expectation we have for the festive season. And we will obviously see some bit of positive momentum in the production schedules for Q3 and Q4. And our top picks within those remain Uno Minda, Gabriel, Minda Corp, and Sona BLW.
Uno Minda, Gabriel, and Sona BLW. Minda Corp and Sona BLW. Got that. That's the auto ancillary space. So to go back to the OEMs, Jay, I guess from what you're saying, it's very clear, right? Frankly, Q2 numbers are a shade irrelevant because it all happened towards the end of the quarter, and then the Diwali commentary, like you're saying, that's been very, very robust. So what would your pecking order be for OEMs across PV, CV, and two-wheelers? If I were to, add, let's say, 3 top auto stocks in my portfolio for the next year or two, which 3 would you go with?
Yeah, I think it would be Maruti, TVS, and Mahindra. These 3 would be my top picks within the OEM space.
Okay, all right. So there we go. We have some picks on the auto OEM side as well as the ancillary side. Thank you very much, Jay. Helpful conversation. And then we'll see what the companies actually have to say as those numbers start trickling in. Thanks for joining in today. Well, with that, we have to take a quick break. On the other side, Manisha Gupta joins in. There's some profit-taking finally setting in the precious metal space. Oil is on the boil because of more sanctions. We'll get you all the details in just a bit. Welcome back. Let's straight away head across to Manisha. Plenty of headlines in the commodity markets. Manisha, welcome back post Diwali. What are you tracking?
Well, I'm looking at metals right now, and I've taken it in a two group, some gainers and some losers as well. I'll start with the losers first, and that really has to come in from the precious metal space. Gold, for example, fell 2% overnight. It was down 6% on Tuesday. We've seen 6% of a decline come in from all-time highs there, but we are still 55% higher for the year 2025 there. So a lot of volatility movement is what we've seen in the last 2 or 3 trading sessions there. Well, what is really leading to a decline? One, of course, is that heavy profit taking after that strong run-up. Gold prices have been overstretched and in overbought territory from the beginning of September, and it continued to make new higher highs for the most of September as well. So finally looking at some profit taking coming in there. And then it has been about a potential US and China trade deal as well that the markets are reading into. That seems to be weighing onto the markets. And then the US has announced fresh sanctions on Russia. Ukraine-Russia ceasefire is something that has been refused by both the countries there. The US consumer inflation data on Friday, well, that is something that will give you further direction coming in for prices. But a bit of an uptick in the US dollar index also seems to be weighing onto the markets right now. Well, there's a report from Citi which says that there is some consolidation that they're anticipating around $4,000 an ounce mark. But a longer term scenario by the end of 2026, you could be looking at higher gold prices from here. And that's not just about gold. Take a look at silver. And we've seen an all-time high of 54.5 into this one. Currently, we are trading at 48.5. So it has been a $5 of a decline for silver as well. The last 1 week has seen 11% of a cut coming in. For the year, we are still 67% on the higher side there. Well, reduced safe haven buying as you're looking at money floating back in case of equities. Even dollar index, for that matter, seems to be weighing onto the space. The India silver rush also seems to be now getting stabilized there. Remember, Indians have bought silver at record highs and with a premium as well. At this point in time, the premium is almost gone, and with silver prices declining so sharply, I believe people who've bought in the early part of the week clearly are sitting on losses at this point in time. But then what is doing quite well has been platinum, up nearly 6% in the overnight markets because intraday gain that we've seen in 2020. And with that, prices are up nearly 74% in this year. Well, a lot of buying that you saw in case of silver seems to be coming in for platinum. So when you look at the platinum physical market right now, it's trading at a premium. There is a physical shortage. Retail and institution wants to buy it. And so all of that story seems to be playing out in platinum at this point in time. Finally, I want to talk about aluminum, and this is a metal that seems to have done very well in last couple of sessions. We are trading at the highest level in 3 years right now. We've seen prices gain up by 10% currently, and currently as well, we're trading in the positive right now. Support comes in from 3 or 4 factors. One, China has capped production at 45 million tons, as good as last year. Second is Iceland key refineries seem to be getting some concerns with the electricity there, so there is a shutdown there. Alcoa has shut the Kwinana refinery in Australia, so supply concerns coming in from that too. And finally, when you look at the LME aluminum stocks, they have seen a decline by nearly 25%, standing just at around 484,000 tons right now. So all reasons to continue to be long when it comes to aluminum.
Okay, all the metals glistening and shining. Got that. Some profit taking, of course, finally coming in on gold and silver. Thank you for that, Manisha. We'll take a quick break on that note. On the other side, Lata connects with the Prashant Kumar of Yes Bank to talk about the bank's performance in the second quarter and the outlook ahead.
Welcome back. Yes, Bank's second quarter earnings had several positive highlights. The net interest margin was flat at 2.5%. Quite an achievement when there has been such a big repo rate cut. The pre-provisioning profit has risen by 32.5% year on year. Profits, net profit, that has also grown by about 18%, which is better than most banks. However, the disappointments were slow pace of advances in deposits growth. That's remained at about 6 to 7%. However, the current and savings account, which is really the low-cost funds for the bank, grew by 12.5%, better than the normal deposit growth. Separately, the purchase of that 24% stake by Japanese bank SMBC in Yes Bank has led to a credit rating upgrade for Yes. To discuss more on margins, on when the bank will reach its 1% ROA, we have with us Mr. Prashant Kumar, the Managing Director and CEO of Yes Bank. Good morning, Mr. Kumar. Thank you very much indeed for joining us. Take us first through the margins picture. I think it was helped by the fact that you lowered the amount of money that you were giving to the very low-yielding RIDF accounts.
Yeah. No, I think that is one of the factors. But at the same time, if you see, like, we have been able to reduce our cost of deposit by 20 basis points and the cost of fund by 30 basis points. Though there was a repricing on the asset side, but I think with the control on the cost of the funds and the deposit, and like you were saying in terms of our CASA growth, is almost double the growth of our deposit growth. I think for last 6 quarters, bank is pursuing a very, very conscious strategy of the profitable growth, both on liability as well as on the asset side.
Okay.
So I think in terms of, if you see even NII, there is a 4.6% growth. And with the control on the cost of the deposit, and RIDF is definitely helping us.
Okay.
Along not only RIDF, and the corresponding refinance also comes down. And refinance always, the borrowings is at a higher rate.
Okay.
I think all these factors are helping us in terms of currently we are able to manage the NIMs at the same rate.
Okay.
But I think definitely it would help us in improving the NIMs going forward.
Okay. Well, just a word to our viewers, RIDF, Rural Infrastructure Development Fund. When a bank is not able to meet the 40% priority sector lending, whatever is the shortfall has to be put in this RIDF, which yields the bank very low returns, 4%, right, Mr. Kumar? So if you can do PSL, you will get better margins. When do you expect to complete your priority sector lending? And an allied question, what is your margin guidance?
I think for last 2 years, we are meeting all the priority sector requirements. So there is no additional call on us except for the prior period, and we are getting a repayment. So if you see, like we were having a RIDF to the extent of almost more than 10% to our total asset, has already come down to 7.8%. And next year, there would be a big repayment of more than 9,000 crores in that RIDF fund.
Okay.
And the delta between what we get on the RIDF and what we can alternatively get in terms of deploying those funds would be like a 4%.
Okay.
So I think all these factors would definitely help us in terms of improving the margins. Okay.
Okay. No, I'm looking for a number if you can. Also, if you can give us a number for the cost of funds, how much it will fall. You have got a credit rating upgrade because of SMBC strength adding to yours. Plus, you are saying you will get back RIDF. If you can also tell us how, if any of the high-cost deposits will mature. So give us an idea of what will be the cost of deposits when we exit this year, end of FY26, and what will be the margins end of FY26.
So, Lata, like first in terms of our ratings, all our ratings have been upgraded before the SMBC transaction.
Yes.
I think subsequent to SMBC transaction, we would be expecting a further rating upgrade, which definitely we need to see in terms of next 1 or 2 quarters. Okay. But in terms of, like, if you see on the deposit cost, okay, and the way we are growing on our CASA deposit, and since our deposits are also coming for repricing next year, okay, and along with the RIDF, we would be definitely seeing an expansion on the NIMs. As of now, I'm not putting a number because you can't rule out a further cut on the repo rate going
Yes.
forward in the financial year.
But you can give us a number for the cost of funds in
The
terms of...
cost of fund is also something like, because the expectation is, and we are seeing the huge demand coming on the loan side. If the similar loan demand come for the entire banking sector, I think there would be definitely fight for the deposits. So I think we would continuously work in terms of reducing our cost of deposit. But as of now, I am not putting a number to both NIMs as well as cost of deposit.
Okay. Can you tell us which vertical, I mean, what, you're one of the few banks where corporate loans has actually grown a little more, 1% higher than it was in the previous period. So will you therefore grow more retail? We understand that because of the GST cuts, retail, there is a retail boom. So can you give us the verticals target to have for retail, commercial and corporate?
So like there are three major components. If you see the large corporates, which is the corporate side, and quarter-on-quarter growth has been more than 7.5%. And actually, if we see even YOY growth on the corporate and institutional banking, it is in the almost 14-15%. I think this segment, we are seeing a lot of demands coming, and we would be definitely growing in the double digit. Okay. The commercial banking, which currently is growing at 16%, is inching towards our target of a 20% growth. So commercial banking, which we are seeing for last 4-5 years, are growing at more than 20%, would definitely happen. Retail, since we have following a very calibrated approach of not go for a very low margin asset products, we would be seeing even the retail growth moving towards 5% plus.
Okay.
So overall loan growth, we are aspiring to be in double digit.
Okay. Are you getting fresh business, any international business, trade related businesses because of SMBC? Will that add to your earnings in any way?
No, I think this is too early, but definitely SMBC deal is giving us a lot of opportunities. Lot of opportunities, not only from the rating perspective, but also in terms of engaging with the corporates, okay, both in terms of meeting their cash management, transaction bankings, meeting their trade requirement, and also taking care of the employees for both retail assets and the...
Okay. So what's your guidance towards that 1% ROA? What would be your return on asset guidance, especially the 1% mark?
We have given a guidance of reaching that 1% ROA for the full year in FY27. We are hopeful that this transaction with SMBC would definitely accelerate that pace.
Okay. Well, you have been given an extension till April. Is your hat in the ring for a further extension, or have moves started for a new MD?
I think this is something which all of us together would take a call in terms of what is good for the bank. And at the appropriate time, we will disclose in the markets.
Okay. All right. So we'll have to leave it at that. Unfortunately, results season and therefore too much of rush. We will invite you for a more relaxed discussion. Thank you very much indeed for joining us, and all the very best. A happy Diwali as well to you and your family.
Thank you. Thank you so much.
Okay, so that's the word coming in from Yes Bank. They're sticking to their guidance of 1% ROE by next year. We'll wrap up on Bazaar on that note. Chartbusters coming up.
The Indian market opens higher and builds on gains as comments from the US President Donald Trump and Prime Minister Narendra Modi's comments suggest some kind of approachment between the two countries. The Nifty approaches 26,100 as all sectors trade with gains, with IT stocks leading the way higher.
And shares of Bharat Forge surge as reports suggest that Bharat Forge and PLR Systems win a rupees 2,770 crore order for close quarter carbines from the Indian Army.
Shares of Infosys rise as much as 4%. The stock is a top Nifty gainer after the company's promoters opt out of participating in the 18,000 crore rupee buyback.
And shares of NMDC fall after firm cut iron ore prices effective Wednesday. Morgan Stanley says that the price cuts are